Hey everyone, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles. Welcome to another video today. This is part of a series of videos that we started a number of months ago, and these videos are basically a video analysis, and each video complements and adds value to a recent Undervalued Dividend Growth Stock of the Week article. I'm going to dispense with some of the usual pleasantries and some of the usual introductions today because we're about, I think this is the 13th video or maybe 14th video that we've done in this series. And of course, every video I kind of spend the first 5 or 6 minutes kind of talking about what the video is all about and what we're going to accomplish. And if you guys have been following along 12, 13, 14 videos in, then you probably understand kind of the format and everything else. But basically, this is just a video series that's designed to break down one of the recent Undervalued Dividend Growth Stock of the Week articles. So when you actually read that article, when you follow along and see all the numbers and see all the ideas that I'm presenting, if you ever feel like, you know what, where do you get this number from? Where does this idea come from? And where is this at? These videos are designed to kind of add to that and answer a number of those questions, any questions you may have. So of course, with the Undervalued Dividend Growth Stock of the Week series that we've been doing since late 2014. If you're at dailytradealert.com and you're at the Dividend Growth Investing heading there, if you click on the Undervalued Dividend Growth Stock of the Week tab, it'll bring you to all of the articles that we've been writing since 2014. You can see some of the recent stocks in here: IBM, Starbucks, Kroger, Target, Travelers, Enbridge, AT&T, and today this video is going to be going over SJM Smucker. So that was the most recent Undervalued Dividend Growth Stock of the Week article that was published on November 19th. Today is November 23rd. So happy Thanksgiving, by the way. I almost let that slip because if you guys have been following my blog or following the video series, I've noted a number of times that I actually moved to Thailand. I moved to Chiang Mai, Thailand, which is in the northwest area of the country. And it did that for a number of reasons. And I love it over here. Of course, though, they don't really have a Thanksgiving, not in the traditional sense anyway, that we would celebrate or that you would celebrate in the United States. But I just remembered today's Thursday. I'm doing this video. I almost forgot because it's so different over here. But happy Thanksgiving. Depending on when you catch this video, depending on when the video is published, it'll be after Thanksgiving, I'm sure. But just wanted to make sure I wished that to you viewers and readers, and I hope it was a wonderful Thanksgiving for you guys. So getting into the article today, of course, it is on SJM Smucker, which is the most recent article that was published as of the shooting of this video. And I'm going to kind of click off the archive here and get right into the article. So with every article I write, and with every Undervalued Dividend Growth Stock of the Week article that's published, as I've talked about in prior videos, I start out with what I call a big idea. Or when you start reading these articles, I like to think of these the articles that I write, these Undervalued Dividend Growth Stock of the Week articles, as not just an investment idea. When you pull up the article, it isn't just, okay, which stock looks good today, which stock looks undervalued, which should I buy? It's not just that, although that's already a lot of value for you as a reader, and of course if you're watching the video as a viewer too, that already presents a lot of value to have this compelling long-term dividend growth stock investment idea, and for free, because there's no charge to read the content. So there's already a ton of value there, but I also want to draw you into why you should even be buying one of these stocks. I mean, it's one thing to just say, okay, well, I'll have some money and I'll buy this stock or whatever, but there's kind of a mechanism behind that. It's part of kind of a paradigm shift that should occur in your mind. It's part of a holistic lifestyle, the investing, the regular buying of high quality dividend growth stocks when they're attractively valued, i.e. when they're undervalued. That should just be one aspect of a holistic lifestyle that's designed to slowly but surely buy yourself more freedom, more time, more opportunities, more flexibility in your life. So, and just I want to make a quick note on this, which Daily Trade Alert added a note at the top of this article. I submit, and I talked about this in prior videos, there's always kind of a bit of a lag whenever the article is published and when I do the video and everything else. I usually submit my article for publication a Thursday before publication. So every article is published on Sunday for that week, which is an Undervalued Dividend Growth Stock of the Week. But I submit my article a few days prior. Usually that small window of time doesn't create any issues, but this time it did because Smucker released its earnings after I submitted my article, and the stock popped quite a bit. I think the stock is still a very strong long-term investment idea, even after the pop up, because it still looks undervalued even after it moved up a little bit after I wrote the article. But that said, the undervaluation has changed a little bit since I put all the numbers together and everything else. And of course, I submit the article on a Thursday, it's published on a Sunday, then I do a video maybe a few days or up to maybe even a couple weeks later. So there's always a little bit of a lag between everything. But that said, these are long-term investment ideas, guys. So when I'm putting these numbers together and when these articles are being published, this should be an investment that you're thinking of for the next 30, 40, 50 years. It shouldn't just be thinking of something like, oh, well, I'll buy the stock for a month or something, and then when it goes up by 10%, I'm going to sell it. That really isn't how you should be thinking about investing. I mean, not every stock in my personal portfolio has been owned since the beginning and never sold. The majority have. The majority of stocks in my personal portfolio, once I bought them, I've never sold them. I only add to them occasionally, but other than that, I just keep them and I collect the growing dividends. But there are a few where I'll sell if there's something that happens to the business, of course. If something, if the dividend is cut or something happens with the company where, it isn't quite the same business I bought into or something like that, or maybe the valuation does get a little out of whack and it becomes overvalued, moves from undervalued to overvalued, and then I move on. But generally with these stocks that I'm presenting, with a company like SJM Smucker, it shouldn't just be like, oh well, it popped 6 or 7, 10% or whatever, and it's not a good idea now. And it's still a good idea. It's still a long-term idea, because you should be thinking, again, for the next 20, 30, 40 years, as SJM Smucker sells more products to more people at higher prices, that kind of moves the numbers and increases the value of the company and should provide for growing dividends over time. But they did make a note here that the numbers were pre-earnings announcement numbers, so just keep that in mind. But getting back to the big idea, or getting back to the buy-in, why you should even be thinking about this, why you should be buying these stocks and everything else. With this article, what I started out with is that truly great products and or services practically sell themselves. So when you think of investing in a good business like SJM Smucker, generally these businesses are companies that, like a Coca-Cola, like a Johnson & Johnson, like a Pepsi, like an Apple, you can go on and on. These companies, when I espouse investing in these businesses, when I personally invest my own hard-earned capital in these businesses, the reason why all of that is happening is because these companies are selling really tremendous products and or services to people usually all over the world. So we're talking billions of people here, and these products and or services are so in demand that they really almost sell themselves. I mean, the marketing for a lot of these companies has been so strong for so long that these brand names are entrenched into society today, to the point where when you think of a particular type of product, these brand names immediately come to mind. Like when you think of cola, you're immediately thinking of Coca-Cola or Pepsi, probably Coke. When you're thinking of a smartphone, you're immediately thinking of an iPhone. I mean, that's almost guaranteed that that's going to happen. And that's because these products are so quality, are so in demand, are so wanted by the populace at large, that when you invest in a company like that, and when you're thinking about growing dividends, there's a certain amount of assurance there that those growing dividends are going to continue to pump into your pocket based on that kind of, based on kind of how that works, on how these products and or services sell themselves, how that mechanism occurs and everything else. So when we look at that, I talk about why companies that have products and or services that practically sell themselves make for good long-term investments, and why they are generally high-quality dividend growth stocks. And I talk about how you can't write a check that can't be cashed, or you can't do it routinely. You might be able to do it once or twice, but you can't do that for years on end. And you certainly can't write bigger checks that can't be cashed. So you can't, if you're going to write a check to somebody and then say, well, I'm going to write a bigger and bigger check for 20 or 30 or 40 years, that can't occur unless you're generating the money to make sure that cash or those checks can be cashed. Okay, so I talk a little bit about why we should be interested in these high quality dividend growth stocks, why we should be investing in businesses with products and or services that practically sell themselves, and how that works to the benefit of a long-term dividend growth investor. And also, when you're an investor, when you think about investing in businesses for the long term, I like to invest with the best. I mean, I think that's true with anything in your life. You know, if you meet someone and you date someone and you want to build a relationship with somebody, would you not want to build a relationship with your best option? Would you not want to build a partnership with the best partner that you can possibly find? Well, the same thing goes for investing. When you partner with a business, which is essentially what it is, it's a business partnership, you should want to partner with the best. You should want to be in business with the best companies out there. And generally speaking, not always, but usually, a long track record of dividend growth tends to be a pretty good litmus test for not just business quality, but also the quality of the business products and or services that these companies are selling. So it kind of works in tandem with one another. There's a complementary relationship there. The products and or services are high quality, thus they tend to sell themselves, thus the profit tends to increase at the company, thus that company is then able to send out growing dividends to its shareholders. Okay, so it all kind of works holistically together and everything else. So when you think about investing, you should be thinking about investing with the best companies out there. And generally, high quality dividend growth stocks represent the best of the best, the creme de la creme. And that's kind of the mantra, that I use to build out my real life dividend growth stock portfolio, which I link to in every article. So you can view that portfolio and see exactly which stocks I'm personally invested in with my own hard-earned cash, because I am investing alongside you readers and viewers. I don't just put out ideas and say, hey, this stock looks good or whatever, and then I'm not interested in it at all myself. I take my own medicine, if we will. So my own portfolio links to over 100 different high quality dividend growth stocks. But the real list, the list that I use to cull from, or the resource that I use to pull ideas from for this series of articles, for the Undervalued Dividend Growth Stock of the Week articles, is David Fish's Dividend Champions, Contenders, and Challengers list, which I also link to in the article. This article contains pertinent data on more than 800 U.S. listed stocks with at least 5 consecutive years of rising dividend payments. So you've got basically a who's who of some of the best businesses in the world because of that relationship I just talked about a couple moments ago. You know, none of these companies got there by accident. You don't just accidentally build a company that can pay out growing dividends for 20, 30, 40 years. That doesn't just accidentally occur. You have to be doing a lot of things right in order to build that kind of business and be able to fund growing dividends to millions or billions of shareholders for decades on end. That whole thing doesn't just accidentally occur. There's a lot of things that have to be in place and a lot of things that have to happen just right over and over and over, day in and day out, for weeks, for months, for years on end. These companies have to make sure that they're operating at peak level all the time. So when you invest in the best of the best, you know that you have, you know, thousands or millions of people working on your behalf to make sure that that company runs correctly and make sure that those dividends continue to pump in your pocket and those dividends continue to grow as well. Okay, so as wonderful as that is, of course, with every article I talk about, okay, you know, why you should be investing in these stocks, how it's going to benefit you and everything else. But you shouldn't just be looking at David Fish's list and just picking random stocks off there. Of course, you should be looking to make sure that the fundamentals are high quality, to make sure that you're looking at growing revenue, growing profit, a pretty solid balance sheet, good profitability. You want competitive advantages in place, durable competitive advantages. And while all that is great, you also want to make sure that the valuation is appropriate. And when I say appropriate, you should be looking for the high quality dividend growth stocks, which you're gonna find once you look through all the fundamentals and make sure everything's good to go with the business. Make sure it is high quality from the start, and then also you want to make sure that you're getting that stock at a good valuation. You want to make sure that you're buying a high quality dividend growth stock when it's undervalued. Said another way, you want to make sure you're buying a high quality dividend growth stock when the price is below its value. So if you estimate the fair value of a high quality dividend growth stock at, say, $50, then you want to make sure you pay as far below that $50 mark as possible. Because first of all, when you're estimating intrinsic value, the key word there is estimating. There's no ability to precisely down to the penny figure out exactly what a business is worth and what a stock is worth. You can't say, well, this stock is worth for sure 100% $52.33. It doesn't work like that. When I put out these estimates and when I look at professional analysis, these are just estimates that are based on a methodology for sure, and the process there may be stringent and it may be a quality process, but it's still just an estimate because there are a lot of things that can happen in business for better or for worse, so which can affect the valuation up or down. So you always want to make sure that you buy in as far below what you estimate fair value to be, and which confers a number of benefits. When you're able to invest in a high quality dividend growth stock when it's undervalued, there are a number of long-term benefits that are conferred to the investor. And I kind of break those down right here. An undervalued dividend growth stock should offer a higher yield, greater long-term total return prospects, and less risk. And of course, this is all, sorry guys, I just had to make sure of something. And this is all relative to what the same stock would offer if it were otherwise fairly valued or overvalued. So if you're looking at a stock, if you're looking at Apple and you think its fair value is $125 a share, let's say, buying that stock at $100 a share is going to provide a lot of these benefits, whereas buying that stock at $150 a share is going to negate a lot of those benefits and kind of turn everything upside down and turn everything kind of against you, because everything's going to be opposite. So when you're looking at that higher yield when it's undervalued, if it's overvalued, you're looking at a lower yield, all else equal. The greater long-term total return potential also flips itself upside down, and you're looking at lesser long-term total return potential. And then when we talk about less risk, you're actually adding risk when you pay more. So when you look at price and value and you try to, you estimate the fair value of what a high quality dividend growth stock is from the get-go, you want to make sure that you're paying as far below that number as possible due to these benefits, because the further below that number you can get, the further below the estimated intrinsic value you can get when you're talking about price, the further below that price is, the greater these benefits are and the less risk you're taking on and the greater margin of safety you have. Because if you estimate a fair value of a stock to be 50 and 6 months down the road something happens with the business, some kind of headline comes out and there's corporate malfeasance, or there's a recall of some kind of product, a massive recall, or there's some new competitor out there that's starting to kick their butt. Anything can happen, so you want to make sure you're buying as far below that fair value as possible, which gives you some breathing room when it comes time to down the road, if crunch time does occur and issues pop up and that fair value may be lowered. You want to make sure that you're not sitting upside down on that investment, especially not within just a few months of buying the stock. So I talk a little bit about what undervaluation provides, why it's so important when you're talking about long-term investing in a high-quality dividend growth stock and everything else. So, and then when you get to undervaluation, while it may seem extremely difficult or something to estimate what intrinsic fair value would be for a dividend growth stock, it's really not. I mean, again, there is a methodology there, and you should be pretty strict with your numbers. You should be pretty conservative when you're estimating fair value, but there's a system that you can put in place that makes the process of valuing any high quality dividend, just about any high quality dividend growth stock, makes that process relatively straightforward and fairly easy. And one process that was presented by fellow contributor Dave Van Knapp is linked to in all the articles, and that's basically his what he calls his lesson on valuing dividend growth stock, and it's part of an overarching series of lessons on how the dividend growth stock investing strategy works, kind of from A to Z. So he talks about what the strategy is all about, how it can benefit you, how you implement it into your daily life, and how to make it as successful as possible for you. Which of course, part of making that process successful is figuring out how to value dividend growth stocks when the time comes to invest. You don't want to just blindly go in and say, well, whatever the market is pricing a stock at must be appropriate, because that's really not the case at all. I mean, sometimes stocks are extremely overvalued, sometimes they're extremely undervalued, and if you're just kind of allowing the market to value your stocks for you, then you're kind of like a cork floating in the ocean, and you don't have any control over your investment success at that point, or very little control, and you're going to be in trouble if that's how you're going to invest. Maybe that'll work itself out if you're buying a stock for 30-40 years and you can kind of hold it for a while and dig yourself out of trouble. But if you're routinely doing that, you're holding yourself back, because if you're going to pay more, you're going to limit your income potential, not only in the near term but also long-term aggregate dividend income potential. Your overall the amount of wealth you can build is going to be limited relative to what it otherwise could be. The amount of financial independence you can buy, at least the time frame for financial independence, could be severely limited, or could be lengthened quite a bit. So for me, I went from below broke to financially independent in what, about 6 years or something like that. So it was not that long, but it was because I implemented all these, as I talked about earlier, all these various aspects into my holistic lifestyle. I lived very far below my means. I lived very frugally. I invested every dime of excess capital I could into high quality dividend growth stocks, but I made sure that when I bought those stocks, each respective stock was undervalued at the time of purchase, which of course allowed me all these benefits I just spoke about: the higher yield, the greater long-term total return potential. I lowered my risk. And so that each time I did that, if you can buy just one high quality dividend growth stock when it's undervalued, if you just do this once in your life, I mean, the amount of wealth and income you could build over 20, 30 years is great. But if you can routinely do that over and over and over again, week in, week out, month in, month out, for years on end, I mean, you can accomplish amazing things. And I'm a pretty good example of that, because I was literally in the hole. I was in debt. My net worth was below zero. As I've talked about before, I was what I call, I was worth less than a baby, because a baby's worth $0, has no assets, no liabilities. So a baby who can't speak, who can't feed itself, can't walk, was worth more money than I was when I was 27 years old. And I thought, this is crazy. I mean, this is nuts. I'm a pretty smart guy. How did I get myself in this position? So I turned it all around. I started saving. I started investing in these businesses. So when I talk about this, when I write about this, when I get pumped up about this, and when I get excited about this, it's because I live the benefits. I'm experiencing the benefits every single day of my life. To be financially independent at a very early age in life is an amazing feeling, and it's the gift that really keeps on giving. You know, today's Thanksgiving, but I feel like every day is a holiday. When I'm financially independent in my 30s, I feel like every day is Christmas, because I wake up and I think, okay, what am I going to do today? You know, what exciting projects am I going to work on? Who am I going to talk to? You know, exciting entrepreneurs I can maybe meet up with. What am I going to have for lunch? All of these decisions that I have control of is possible. That dynamic is possible because I'm financially independent. Otherwise, it's just the same old, you know. Well, I got to get up at this time. I got to go to work at this time. I have to do these jobs my boss tells me to do. I have to go here for lunch. I only have this much time to eat. I got to, you know, so on and so forth. You don't really have control over your decisions, or at least not as much. So, so when I write about this stuff and I talk about this stuff, I get really excited because it literally changed my life. And when I present these ideas, when I talk about this stuff, when I write about this stuff, when I'm speaking about this stuff, I do so with a level of enthusiasm, because I think it really can help you. I think if you're watching this video right now, I'm presenting these ideas because I'm trying to inspire you. I'm trying to motivate you for you to become a better version of yourself every single day. And so that's what this video is about. That's what we're talking about. So we're going to dig into the stock right now. So the stock, of course, as noted earlier, is GM Smucker Co. People might not know the company just by GM Smucker Co. Smucker probably gives it away a little bit because it's one of their top brands, the Smucker jams and jellies. But GM Smucker is a lot more than just jelly, as we'll talk about throughout the video, and of course as I wrote about throughout the article. So they have a number of iconic and well-known brands, and I kind of lay out a couple of them. We've got Smuckers, Jif, Crisco, Folgers, Meow Mix, Kibbles and Bits. All of these brands, as I spoke about earlier, when you start to think of, I kind of break it down right here. When you think of high quality peanut butter, you immediately think of Jif. I would say that's true for probably 9 out of 10 Americans. If you ask them, name a brand of peanut butter, go, they're going to say Jif. I almost guarantee you that's what's going to happen. When you think of a high quality jam, you're going to think of Smuckers. Say name a brand of jelly, Smuckers is immediately going to come to mind. And again, that's because these products sell themselves. You know, these brands are entrenched into society. When you think of a high quality at-home coffee, you're probably going to think of Folgers. I would say Folgers probably not as immediate as Jif and Smuckers, but it's right up there, guys. If you look at the average American, when they're buying at-home coffee, Folgers is going to be, you know, one of the most popular brands out there. So high quality products and or services practically sell themselves, and that's certainly true with this company. And we can kind of see that with the market share of some of these businesses. And I want to kind of break that down a little bit. I've got the most recent annual reports pulled up here. And this is 2017. What is this? This is page This is page 41. I just want to go up to something here real quick, guys, and kind of show you when we talk about these brands selling themselves, I want to show you how that looks. I'm scrolling down here through the most recent annual report, which we're going to get into for the financial statement. So when we talk about market share, when we think of high quality brands, if you have a really strong brand, you should be the #1 brand in your category for market share. And so we can see that right here. Market share for peanut butter, Jif, #1. Market share for at-home coffee, Folgers, #1. Market share for fruit spreads, Smuckers, #1. Market share for dog snacks, Milk-Bone, #1. And we go down here, we go down a couple more. Market share for flour in Canada, Robinhood, #1. Market share for premium bag coffee, Dunkin' Donuts, #2. And you've got a couple of growth rates for a couple of their other brands. They've got a lot of brands. I'm only listing a few of them because we have to be a little careful with how long these articles get and how long these videos get and everything else. But so again, when you think about high quality products that sell themselves, GM Smucker has quite a few of them in their roster. So, and while I think if you're maybe an investor who isn't super familiar with this company, you may think that it's primarily a peanut butter and jelly business. You may think that, okay, well, they've got the #1 share in peanut butter with Jif, they've got the #1 share in fruit spreads, excuse me, with Smucker, so they must be primarily a peanut butter and jelly company. And that's actually not true at all. I kind of break down how their sales is broken out across the business when you look at their individual segments. So the coffee product category, that actually generated 34% of their fiscal year 2017 sales. Pet food and pet snacks generated another 29%, and then the peanut butter and fruit spreads combined for 15%. And they've got some other food products in there as well. So when I think of this company, I actually think of it as a 1/3 coffee, 1/3 food products, and 1/3 pet foods product. It's kind of all those different segments make up about approximately 1/3 of the business. So when you imagine GM Smucker in your mind, you should be thinking, okay, it's 1/3 food products, 1/3 pet foods and snacks, and then 1/3 coffee. That's pretty much how the business breaks down. You know, they certainly have the #1 market share with the peanut butter and jelly, but the way that the company actually breaks down is that's really how it is. It's 1/3 of each. And I kind of note I make a quick note up here when I'm talking about how the company breaks down and everything. As I noted earlier on in the video, I live very frugally. I still live very frugally. I'm living extremely cheaply here in Chiang Mai, Thailand, and it's one of the reasons I came over here is because of the incredible value that you're able to get for your money over here. But while I was still in the United States, and certainly while I was trying to dig my way out of being in debt and trying to become financially independent, I've eaten a lot of peanut butter and jelly in my time, guys. A lot of peanut butter and jelly. So I have a certain affinity for this company. I have a certain love for GM Smucker, maybe a little more intimate than the average person or whatever because of the pure amount of peanut butter and jelly I've consumed in my life. And I just recently became a shareholder in GM Smucker not too long ago because the stock had gotten to a point where I felt like the value was strong enough to invest in it, which I did. And of course, if you follow me on social media, if you follow my posts, anytime I buy stock, I talk about it almost right away. But it was wonderful for me to finally invest in GM Smucker. So if you're at home, if you eat peanut butter and jelly, if you're using these products, it's really wonderful to own a slice of a business that you know that sells products that you're personally using, because all you're doing is you're funding back into that profit and funding back into your own growing dividend, which is this really wonderful cycle where you're buying these products and these products are you know bringing you enjoyment or getting you to where you need to be, and then you're giving that company the money that they're going to be using to profit off of, and then which is going to be coming back to you in the form of growing dividends. So it's a really cool little cycle there that I like to be part of. So getting into the dividend, of course, that's why we're all here. I'm a dividend growth investor. You're probably a dividend growth investor if you're watching the video, if you're reading the article. That's really the well, I'd say the bread and butter, but we'll call that the peanut butter. The bread and peanut butter, we'll call it that today. That's kind of what we're getting into. That's what we're talking about. That's why we're investing in these stocks, because we want to collect that growing passive dividend income potentially for the rest of our lives, right? So, of course, if this company didn't have a growing dividend growth streak, it wouldn't be talked about, it wouldn't be in the video, I wouldn't be writing an article about it. Getting into their dividend and their dividend growth, I note right here they've paid out an increasing dividend for 20 consecutive years. And if we pull up David Fish's list right here, I've already got it kind of highlighted. We've got the consecutive years of dividend growth right here, 20 years, which is pretty impressive. And I see no reason why one day JM Smucker won't have a dividend growth streak of 40 years, 50 years, 60 years. I see no reason why that won't eventually happen outside of maybe them being acquired by somebody and the business, you know, as an independent business maybe disappearing. But if they stay as they are, I see no reason why they won't continue to grow their dividend for many more years. So they've got 20 consecutive years, which is pretty impressive in its own right. And then looking at the dividend growth, they've grown their dividend at an annual rate of 9.8% over the last decade, which is really strong. You've got that right here, 9.8. But as I've talked about in prior videos, one thing I like to look at is either an acceleration or deceleration in the dividend growth. And we see a deceleration here with GM Smucker and their dividend growth. So you see the 10-year at 9.8, you've got the 5-year at 9.1, you've got the 3-year at 8.9, you've got the 1-year at 8.4, and the most recent dividend increase was 4. So it's a little disappointing there when you think, oh well, the last 10 years, if you know, older shareholders were getting, you know, this massive dividend growth, and now it's decelerated to the point where we're talking mid-single digits. And yeah, that is disappointing, but I think the company's really primed, they're positioned very well to kind of get back to more impressive dividend growth. Maybe not this 9.8%, you know, that's not really sustainable over an extremely long period of time. They were doing it there for a little while, but I think this 4% is probably on the low end, and I don't think if we're building an expectation for future dividend growth, I think that 4% is a little unrealistic. So somewhere in the middle here seems more appropriate as we'll kind of get to as we break down the company's fundamentals, its dividend, and everything else. Of course, we want to look at the payout ratio, which tells us how sustainable the dividend is. Their payout ratio is 65.7% right now, which is it's a little high. You know, it's a little higher than I'd like to see, but as I note in the article here, their free cash flow continues to comfortably cover the dividend just fine. With the payout ratio being a little elevated, though, I do note right here that the dividend growth, at least over the near term, should roughly mirror earnings growth. So whatever they're going to grow their earnings at over the next few years, the dividend will probably mirror that roughly. But with the free cash flow comfortably covering the dividend, again, I would expect dividend growth to be, you know, not at the 4%, the most recent dividend increase, maybe not at the 9.8% that we see over the last 10 years, but somewhere in the middle there I think is very appropriate for this kind of business. Looking at the quality of the brands, looking at the long-term growth, looking at the future growth potential and everything else. And one really attractive thing about the stock, at least when I put the numbers together, the stock was yielding 2.93%, which is extremely high for the stock. I've been investing since, 2010, since I guess late spring, early summer of 2010. So we're going on 8 years for investing. And for the majority of the time that I've been investing, and again, as I noted a little bit ago, I just recently bought stock in this company. It wasn't that long ago. So all these years have gone by, and I've never been able to buy stock in GM Smucker because there was maybe some other better opportunity. You know, of course, our capital is limited, you know, so the number of opportunities we have is somewhat limited as well. And for a lot of that time, the stock just wasn't yielding that much, you know, just didn't really get me to where I wanted to be. I always wanted to see the yield, you know, higher, you know, closer to maybe 3% or so for the stock, for it to kind of make sense for me. And just recently, because of the way the stock has kind of come down quite a bit and the way the dividend's been growing real nicely over the last 10 years, those two things have kind of coalesced into the stock providing finally a fairly attractive yield. Now the yield is at what, 2.77%, so it has come down since I put the numbers together, and since when I personally invested in the stock, when I bought the stock, which was not that long ago, the yield was actually a little over 3%, and it's been kind of coming down ever since. So I may have kind of gotten lucky there and caught it near its bottom. But the yield still 2.77% is very attractive, as we'll kind of show. If we look at what the stock has been averaging in terms of yield over the last 5 years, it's well below that. We can see the 5-year average on this stock is only 2.2% right here, guys, right? So the 5-year average for the yield, 2.2%. And a lot of that time, man, when I pull up GM Smucker stock and think, I'd really love to buy this business. I think it's great. I love the brands. I love what they're doing with the company. I personally use their products quite a bit. I was eating a lot of peanut butter and jelly while still in the States. And it's a food company. These are high quality products that sell themselves. I think they have competitive advantages. So the fundamentals made sense for me. The only thing that held me back was really the valuation, and which of course affected the yield negatively. And a lot of times it'd be 2.1%, 2%, maybe 2.2%. Sometimes I see 2.3 or something. Just was not there for me. But you see now, with this yield at almost 2.8%, there's a pretty healthy spread there between the 5-year average and where it's at now. When I wrote the article, that yield, that 2.93%, was almost 80 basis points higher than the stock's 5-year average yield, which is rather significant, especially for a high quality food products company. Which these food stocks like GM Smucker, like a General Mills, like a Kraft Heinz, a lot of these, like a Hershey, a lot of these food brands, their valuations have gone through the roof lately as investors have sought out pretty safe yields in a low interest rate environment, and as some M&A activities occurred and everything else. So these valuations have been pushed up into the stratosphere, and really to the point where it doesn't make sense to invest in them. And just recently, some of them have come way down. I recently was buying General Mills. I wrote about General Mills not too long ago. I did a video on General Mills. GM Smucker, same thing. I've been buying GM Smucker because I thought the yield had gone up because the valuation had dropped and it started to make sense again. When you're getting a yield near 3%, it's still not that far away. On a company like GM Smucker, I think that's kind of a very good level to start to think about pulling the trigger and start to think about buying the stock. So we've got the yield there, we've got the payout ratio, we've got the compound annual dividend growth rate for the dividend, and we've got the 20 consecutive years. So really good numbers here. You've got a yield near 3%, and even after the pop, it's 2.77%. It's come down a little bit, but we're closer to 3 than we are to 2, and we're certainly closer to 3 than we are the 5-year average, and it's certainly still well above the 5-year average yield, even after the stock popped after earnings. And again, as I noted earlier, if you're just relying on the market to tell you when stocks are undervalued or overvalued, that's really not a good way to think about things, because before earnings came out, GM Smucker was in the toilet. Earnings came out and people remembered, oh yeah, this is a great business. And then the stock jumped up through the roof. So you can't rely on the market to really accurately value stocks. I mean, sometimes price and value can wildly diverge. Over the long run, price and value tend to more accurately reflect one another, but over the short term, when you're just looking at a stock in the moment, in real time, its price may not even come close to what it's actually worth. So you got to do your own homework. You have to actually go through, look at the fundamentals. You have to come up with your own process or methodology to value those businesses, to estimate intrinsic value, and then make sure you're making the right decisions when it comes time to buy stock. So we're moving on from the dividend, because when we think about valuing a business, the first thing we need to know is what kind of growth we're expecting from this company, because we're not investing in where GM Smucker was a year ago or 2 years ago or 5 years ago. We're investing in where GM Smucker is not only today, but really where it's going to be going forward. Because when we're buying a stock today, we're not buying past earnings, we're buying future earnings. So we have to start to build an expectation for growth going forward. Of course, the best place to start building that expectation looking forward is where they've already been. And when I start to go through these numbers, keep in mind that I'm not saying, oh well, GM Smucker grew at this rate and that's where they're just going to continue growing, so we're buying into that past growth. That's not the case. However, that said, when you start to look at future earnings growth, when you start to build a model out, you start to think, okay, well, where do I think this business is going to grow? What do I think its growth rate is going to be? The best place to start really looking at that is long-term growth, because if a company demonstrably has a growth rate of, say, 8% or whatever, and they've been doing that over a long period of time, then you should be starting to think, okay, well, if they're able to grow the business at 8% over the long run, then that's probably a pretty good place for me to start to build an expectation for going forward, unless something massively has occurred recently, or unless something massively will occur down the road, in which case, again, you want that margin of safety as we talked about. But that kind of starts to build an expectation for you. So while we are not investing where business has been, we are starting to build expectation based on where they've been, and that starts to build out the valuation and so on and so forth. So we're looking at the last 10 years, which I use as a proxy for the long term. The two numbers we're going to look at is revenue growth and earnings per share growth, top line growth, bottom line growth. So we're looking at revenue first. And we've got the numbers right here, but I'm going to show you where those came from. I've got two annual reports pulled up for SJM Smucker, which you can find on their investor relations site page. I've got the annual report from 2008, and I've got the annual report from 2017, which is 10 years of financial data. And if you want to pull up these numbers on Morningstar, as I've talked about before in prior videos, Morningstar is generally accurate. If I had to put a number on it, 90–95% of the time with these numbers. And you can see they have the last 10 years of key ratios already pulled up here. But I like to go straight to the source and pull up the annual reports, because that way you're, 90–95% accurate is really good. But when you're investing with your own money, I think you want to be 100% accurate. You want to be 100% sure of what you're looking at. At least I do when I'm putting my own money at work. So first thing we're looking at is revenue. Of course, we've got net sales at 2.5 billion right here. Gotta quit that. 2.524 billion, 2525 if we're rounding up here. We've got the 774 million on the end, so it's a 2.525 billion, which I've got noted right here, 2.525 billion. And then we've got the most recent fiscal year. We've got sales at 7.392 billion. That's rounded down, 7.392, and that's between fiscal years 2008 and 2017. So it's 10 years of fiscal year information. Which again I use as a proxy for the long haul, because going out 20, 30, 40 years may not really represent what they're doing today. I mean, if you're looking at the last 10 years, that gives you a pretty good snapshot of what the company looks like today and what they're probably going to be doing moving forward as the business looks right now, barring any major changes up or down. And of course, we're looking at the compound annual growth rate of that, so let's punch that in. So we've got, what, 2525? And I use Investopedia's compound annual growth rate calculator. You're free to use, whichever one you'd like. They all work the same. And we've got 7392. And we're using 9 compounding periods, because the first year, that 2008 year, is not a growth period. It's a starting point, right? You're not growing from the same year you're starting from. 2009 would have been the first growth year, so that's why you're starting from 2009 forward. So it's 9 compounding periods. And that's a compound annual growth rate of 12.68%, which I've got noted right here. The next thing we're looking at is earnings per share growth. And I want to note that revenue growth is really impressive. This is kind of a smaller cap company, not quite as mature as some of the bigger food brands that you might see out there. Their market cap's at 12 billion. So if you want to call it a mid cap stock or whatever you want to call this company, it's a smaller company. It's not as big as like a General Mills, certainly not as big as a Kraft Heinz, some of the bigger players out there. It's definitely smaller, but they have grown quite a bit over the last decade, most notably through some major acquisitions. The biggest of which was the 2015 $5.8 billion acquisition of Big Heart Pet Brands, and that acquisition gave the company an immediate and large presence in the pet foods and pet snacks space. So of course that impacted revenue quite a bit. And so when we look at that 12.68%, it is impressive, but we have to keep in mind that the company expanded quite a bit through this acquisition. So that really kind of moved that top line number up. So the better number to look at, especially in this case, pretty much always, but especially in a case where you've got a major acquisition affecting sales, is the earnings per share, because that tells you not just absolute growth. You want to look at relative growth. You want to look at actually how much profit on a per share basis, because we're buying shares in this business. We want to know how much growth each individual share is experiencing, okay? So we're going to look at earnings per share next. So we've got the 2008 annual report pulled up. We've got net income assuming dilution on a per share basis of $3. I've got that noted right here. And then the most recent fiscal year, we've got net income assuming dilution of $5.10 a share. I've got that noted right here. So we've got to pull that up, 3 to 5.10. 9 periods still, of course. And that's a compound annual growth rate of 6.07%, which is pretty impressive. I might expect a little better than that from a company like this, because, SJM Smucker is, I guess I would call it a mature business, certainly within its space, but it's also somewhat of a smaller company. So I tend to look for mid-single digit bottom line growth from most mature businesses. With SJM Smucker, I might expect a little more than that, maybe higher single digits. 6 is getting there. I might like to see something closer to 7 or 8 or even 9. But we can see also why the payout ratio is a little high, right? We saw the payout ratio over 60% earlier in the video, and that's because that dividend's been growing at near 10%, while the company's only grown at 6% over the last decade. So SJM Smucker has been really wonderful in terms of rewarding its shareholders with a growing dividend, saying, hey guys, here's a 10% raise. Here's a 10% raise. Here's a 10% raise. And that's all good and dandy for your income and money in your pocket, but it came at the expense of potentially near-term and near future term dividend growth, because the company's going to want to scale that back just a little bit. And I think that's why we saw the most recent dividend increase at only 4%, because this acquisition stretched the business, as well as we'll talk a little bit about when we get into the balance sheet. James Smucker is going to have to start paying down debt a little bit. They're going to have to start being a little less flexible with their cash flow. So instead of just handing out those big 10% dividend increases going forward like they were doing over the last 10 years, we really shouldn't expect that, because the business hasn't grown quite as fast. They've taken on a big acquisition, which has stretched the balance sheet a little bit. And so, they got to kind of get that acquisition fully integrated within the business, make sure they recognize all of the potential from Big Heart Pet Brands, start to grow the business a little faster, pay down a little bit more debt, and then they're going to be a little more flexible with that dividend growth. But over the next few years, might not expect 10% dividend growth. Actually, I don't think at all going forward. And maybe over the next few years, it might be mid-single digit. But I think looking over the long haul, they can start to accelerate that again and get that to a pretty nice level. So we see where they've been at over the last 10 years. We've got top line growth. We've got absolute growth in sales, in terms of sales, almost 13% annually, which is really incredible. We've got bottom line growth there in terms of relative growth, though. We've got that at 6%. So it's certainly still solid. And I think that as this acquisition starts to fully materialize within the company, I think that number will improve a little bit. But even 6%, that's not terrible. It's not bad. It's just a little lower than what I think the company is capable of. And of course, when we build out the expectation for future growth, okay, so we looked at what they did over the last 10 years. We can say, okay, sales grew at almost 13, bottom line's growing at 6. But where do we think they're going to go at going forward? Factoring in this major acquisition that just came on board, less than 2 years ago, and they're trying to materialize that and trying to fully build that into the business. Will that not present an opportunity for growth acceleration and better potential moving forward? I think so. And one of the places I like to look at for that is when we pull up CFRA, they have what they call a 3-year projected earnings per share growth rate. So what they have this number at, basically what CFRA is saying, is they're saying that looking out over the next 3 fiscal years, they're projecting earnings per share growth on a compound annual basis at X, whatever the number is. And in the case of James Smucker, they have that number at 10%. So basically what they're saying is, which let's see, where did I note that? Yeah, I've got that note right here. Looking forward, we may see something closer to that, because I say right here, I would like to see something closer to 8% to 9% for a smaller company like this, because the market cap's just under 12 billion. Like I was just saying, I think the potential for James Smucker is better than 6%. I think that's really on the low end. Not terrible, but a little disappointing, and I think they're really capable of better growth than that. And looking out over the near term, CFRA is predicting that James Smucker Co. will compound its earnings per share at an annual rate of 10%. So that's over the next 3 years. And that would be really closer to what I would expect for James Smucker. So if they fall a little short of that and come in at 8-9% over the next 3 years, and maybe over the next 5 to 10 years, that would be a little short of that 10%, but I still think that's right in line with my personal expectations for what this business is capable of as they start to really kind of fold everything in and start to really materialize that acquisition and fully realize all of its potential and everything else. So, and I note where they come up with this forecast, at least what CFRA notes. Part of this forecast is predicated on anticipated synergies from recent acquisitions that haven't had time to fully integrate into the company's business. Ongoing share repurchases will also help, and then we've also got some cost cutting. And one huge area of growth, which I don't know if CFRA notes it. Let me just see what they have here. They've got softer volumes, unfavorable impact of higher prices, promotional spending, active repurchase program. Of course, I note in the article we've got some. They've got notes on margins, gross margin widening. Yeah, I don't think they really noted too much. Price increases in products on coffee, peanut butter oils, and Uncrustables. Anyway, what I note in the article, I don't know if CFRA really got into it too much, but I note that the one area of massive growth potential for James Smucker is, which I call low-hanging fruit, that's their international exposure. The U.S. side of the business, guys, accounted for almost 90% of the company's fiscal year 2017 sales, which means that less than 1/10 of the business is on the international side. So they have this huge, I mean, the domestic market's pretty mature, right? I mean, there's not going to be a massive explosion in Jif sales or Folger sales or Smucker sales or anything like that. They're going to grow at a nice rate as they start to move more product, maybe some volume increases. They cut the costs in the business. They increase prices slightly on their products. So they've certainly got some growth potential there on the domestic side, but it's the international side that's really massive as they start to break into new markets, as they sell more. They have huge runway for volume. I mean, volume on the domestic side is, the volume potential is not that great, but internationally, the volume potential is almost unlimited theoretically, right? I mean, all of these countries. I mean, I'm here in Thailand, and I can go down to the local international grocery store, and I can find Jif, I can find Smucker, but they don't have that much of it. And if you go to different grocery stores that cater to local people, you're not going to find really any of these products. And that's partially because of how expensive they are relative to maybe some local food options. But you know, as their international business grows, as they build that out, as that scales out, you know, as they're able to get their distribution correct, and if they're able to price these products correctly, looking out over 20, 30, 40 years, I mean, that growth potential is really massive for the company. So even with just pretty much being a domestic business, even with this acquisition coming on board, and they're not able to fully materialize that yet, they're still growing at 6%, and there's definitely some room for acceleration there. And really, if we want to talk about international exposure too, there's room for a lot of acceleration. They're looking out over the next 10, 20, 30 years. So I've got here about that international growth potential. And I note here, even if they fall a bit short of that 10% expectation from CFRA, I think, as I noted, 8% to 9% compounding annual growth in the company's earnings per share would be a very appealing result. And that would set the stage for like dividend growth. That would put GM Smucker in a position to grow their dividend at 8% to 9% very easily. You know, again, if over the next few years we start to see dividend growth at 5-6%, somewhere in that range, that would not be totally surprising to me, only to maybe see that being made up for later down the road, especially if they're able to get closer to that 10% expectation out over the next few years. And if they're able to accelerate even more from that, they could certainly grow that dividend at almost near double digits, at least for the next, I think, 5 to 10 years. Looking at a long haul, that would settle into a much lower number, but still a very appealing picture in terms of what you're getting in terms of yield right now, which is near 3%, and then the potential for that dividend growth in the mid-single digits. I think it sets a stage for a pretty appealing total return, with it being a little undervalued right now, even after the earnings pop. So we get into the other fundamentals here. We get into the balance sheet and the profitability. And one thing I note here, the company has typically sported a very strong balance sheet, but it's taken a hit recently with the aforementioned Big Heart Pet Brands acquisition, and we'll kind of see what that looks like right now. We're going to move on to the balance sheet here on the most recent fiscal year. So let's see here. Yeah, so we've got long-term debt right here, 2017, and we can see here in 2016, right, they had 5.146 billion, and they've now got 4.445 billion. So they have been paying down debt. And if you follow their press releases, I don't have all their press releases and quarterly statements pulled up for these videos, because it's just I'm trying to keep these videos to under an hour, so it packs in as much information in as short a period of time as possible for you guys. But one thing they are targeting is to improve their balance sheet, because they have historically carried around a very strong balance sheet. It's recently taken a hit with that massive acquisition, which was really huge for a company of this size. And they have paid it down a little bit, but it could still be improved. It could still be improved from here, and I think the company will continue to improve that. So keep that in mind. If they hand out 5-6% dividend increases over the near term, and you're thinking, oh, this is disappointing. I bought in this stock thinking I'd get a near 3% yield, and I'm expecting 7, 8, 9% dividend increases annually. I think looking at a long haul, we can certainly get there, but over the next few years, guys, just keep in mind that they're trying to buy back stock. And really, which is a great time for it, because I think it's undervalued. So you would want GM Smucker to be buying back stock right now, with the stock being where it's at after it's taken a bit of a dip. And they're trying to also clean up that balance sheet. So as a long-term owner, I can appreciate moves like that. But getting into where they're at with the balance sheet, the first thing we're looking at is long-term debt to equity ratio. So we've got 4.445 billion on the debt. Actually, just round that up. I just see I can round that up right here, right, guys? So we got 445.5, so I'm just going to round that up. And then we've got shareholder equity at 6850, just under 6.9 billion. So we've got a long-term debt to equity ratio at right about 0.65, which I note right here. I just rounded that up. And as I've noted in all the videos, I think the long-term debt to equity ratio, it is a bellwether metric. It is an important number that a lot of people look at. I personally don't place a lot of importance on it simply because the equity side of that equation can be affected by so many different things, and some companies out there have negative shareholder equity even though the company is very profitable. So I don't place a lot of importance on this. That said, the number has been better in the past. Let's just see where it was here back a decade ago. Let's just take a quick look. They have long-term debt right here, right? 789 million. They've got total shareholder equity 1.7. Actually, we're just going to round that up. Yeah, you can see the long-term debt to equity ratio was 0.44 a decade ago. So the balance sheet is not terrible now. I'm certainly not saying that, but I am saying that it's taken quite a hit with the acquisition. That all said, the interest coverage ratio is really the number I place a lot more importance on, because that tells me what the wherewithal of the business is in terms of paying off its interest expenses each year, and that's looking at EBIT. So we got the interest expense right here at 163 million. We've got income before income taxes at 878 million. We got to add that in. We got to add the interest expense back in because it's taken off the income before income taxes. So if we want to get EBIT, we got to add the income before income taxes and add in interest expense, right? So we got to add that 163. So we got 1041 divided by 163. So we've got an interest coverage ratio of 6.4. Again, not as good as the company has historically been. Not fantastic. It's not terrible. Any number below 5, I start to get a little concerned about when we start getting in the low single digits. They're covering their interest expense via EBIT a little over 6 times over. Not fantastic. Not overly terrible. It's not concerning. I'm certainly not saying they're in any kind of financial trouble at all. But I think this number could be improved. I think GM Smucker knows it could be improved, and that's why they're making moves. They're attempting to improve their balance sheet going forward. So just keep that in mind with the dividend growth. You know, they can only do so much with that free cash flow, and they're trying to improve that balance sheet while simultaneously buying back stock and paying out shareholders an increasing dividend, which is a wonderful juggling act, and I applaud it. But you know, if dividend growth suffers over the next couple of years while they really improve the business, I don't really have a problem with that. And I don't think anybody who's in this business for the long term, if you're in this company for the next 20, 30 years, you should want moves like that to happen. You shouldn't just be thinking, you know, short term, I want my dividend growth at 9-10%. I don't care about the balance sheet. That's not really how you want to think about when you think about being a partner with a business. You want to think about being partnered up with the best of the best, with a high quality business, and one element of a high quality business is a good balance sheet. And right now, looking at GM Smucker here relative to where they were a few years ago, yes, the business is not quite as high quality as it was when just looking at the balance sheet and when looking at some of the numbers, because they've changed so much. But I think over the long run, diversifying the business and getting in the pet space, I think it was a good move. And time will tell on that, obviously. The next thing we're going to look at is profitability. We're looking at net margin return on equity over the last 5 years. And what I did with that, guys, I basically just take a look. I can pull up the annual reports and actually, you know, we can calculate the numbers. And I've showed you in prior videos how you get all these numbers. With net margin, you're basically just taking a look at net income against sales, right? So we've got net income right here. And we've got net sales, 73.92. So we've got net interest at 8%, somewhere in that range. And we've got the average at 8.41% over the last 5 years. Where I got that number from, I just basically averaged these numbers here. So you got net margin right here. You take a look at these, take a look at the last 5 years, you average that out, and return on equity, you take a look at the last 5 years and average that out, and I'll kind of show you what that looks like here real quick. So we've got net margin 7.97, 8.78, 6.02, 10.07, and 9.23 divided by 5. We've got 8.41 right here. And then return on equity, same thing. We've got 8.51, 9.73, 5.66, 11.11, and what is that, 10.55? Divided by 3. So we've got 15.21% on the return on equity. Whoop. I did something wrong there. Hold on a sec, guys. Sorry about that. 8.51, 9.73. If I rewatch this video, I'm sure I'll see what I did wrong. Whoop. That's probably it right there. I didn't hit the right number. 10.55 divided by 5, 9.11, 9.11. So these numbers are good. You know, there's good numbers here. I think Google Finance will usually list out a couple of competitors and you can kind of compare James Smucker to where they're at. So you see net profit margin. You see General Mills right here. You got some better numbers there. Tyson Foods way down here. You got ConAgra. So James Smucker, they're good numbers. These are good. I have no problem with their profitability whatsoever, other than the fact that, you know, maybe there hasn't been margin expansion, and maybe even over the last kind of few years there's been a little bit of a compression there as that acquisition came on board. You can kind of see here we were kind of near 10% here for a while, right? And then 2015 the acquisition came on and it's kind of dipped a little bit. And you can see Morningstar's accuracy. I came up with 8% on the net margin. They're at 7.97. We're within a couple basis points. I mean, that's pretty accurate. Yeah, there's been a little bit of compression. But if they can move the business back in the right direction, which I don't see why they won't, then we can get right back to where we were. That'd be maybe the only issue here. But if you look out over the real long haul, there's kind of a little bit of a spike and then a lull. It's been relatively stable though. Profitability is pretty good though. I don't think you'd have any issue with that. Moving into the valuation, when I put this article together, the PE ratio is 22.41. The PE ratio right now is 22.79. That might look a little high, but if you compare where this company has been over the last 5 years to where it's at now, it is a smaller company with growth potential, especially on the international side. The 5-year average is 23.7, so there's a little bit of a drop there. And you can see here on the other basic metrics, price to book 1.8, 5-year average 2, price to sales 1.8, 5-year average 1.9, price to cash flow 11.5, 3-year average 13.1, and then we know the yield as we talked about earlier. So every basic valuation metric is lower. Some are considerably lower, at least on the cash flow side, to the recent historical average, to the respective recent historical average. So the stock definitely looks cheap relative to where it has been over the last 5 years. And maybe you could say, well, the stock was maybe just a little expensive over the last 5 years. Maybe it's closer to fair value today. You could make that argument, but I'd say that, and I'm not making the argument that James Smucker is massively undervalued, especially after the earnings pop. But I think that there is an opportunity here, especially if you're in the business for the long haul. So the 5-year average of the PE ratio is closer to 24. It was 22.41 when I wrote the article. So I think that's a pretty nice discrepancy there, advantageous discrepancy. And of course, I do the dividend discount model analysis with every stock, as always with every stock I write about in these articles. And we're going to get into that right now. I've got the discount rate at 10%, of course, because it's not a particularly high yielding stock. We have to know the dividend looking out over the next year, which let me just pull up their dividend here. I think it's 78 cents a quarter even. It is. I'm going to pull off a couple of these windows so they don't slow my computer down too much. So we've got the quarterly dividend at 78 cents. That's an annual dividend of $3.12. We've got the discount rate at 10%. And then I put the dividend growth rate at 7.5% here, guys, which I think is pretty reasonable. We've got the near-term forecast for earnings growth at 10%. We've got the long-term growth at 6%, but that's factoring in acquisition that hasn't really been fully kind of built into the business, hasn't been fully realized by the company. You know, they've got to fully integrate everything and make sure everything works. And I think if you look at the long-term dividend growth rate of near 10, you look at the expected earnings per share growth moving forward at 10, you've got a fairly modest payout ratio, especially when looking at free cash flow. 7.5% really splits the difference between where they've been over the last 10 years in dividend growth. The most recent dividend increase, I kind of came out somewhere in the middle there, and I think that's pretty conservative. I think, again, maybe over the next couple of years you could see 5-6% dividend increases, somewhere in that range. But I think you might see that made up with 8-9% dividend increases after the business starts to really right-size itself, and as that international growth potential really starts to break out over the next 10, 20, 30 years, as I spoke about before. And I think building an expectation for 7.5% dividend growth over the long haul for the next few decades, I don't think that that's unreasonable at all. So if we calculate that out, we've got a fair value of 134.16, which I note right here. And I kind of break down why I think the dividend discount model analysis is relevant to these stocks. And I also note right here that this is just my analysis. This is just my valuation perspective, which is why I like to compare what I come up with to what professional stock analysts come up with. And I use Morningstar and CFRA. And we're going to look at what they came up with right now. So Morningstar's got their fair value estimate for GM Smucker for SJM at 132. And I note that right here. And they have it as a 4-star stock, which right here, 4-star rating, right? And then CFRA rates it as a 3-star hold with a fair value calculation of 102.77. So they've got the 3-star hold right here. And they've got their fair value calculation right here. So yeah, they moved it up a little bit, guys. As I've talked about in prior videos, CFRA seems to change their numbers almost weekly. And they've got a timestamp on this of November 20th, which of course was just, what, Monday. That was after the article was published, which was Sunday, and it was certainly after I compiled the numbers. So they moved this up a little bit. So if we want, we can kind of revalue that, because that has moved up somewhat materially. That's a considerable change in the valuation. So if we re-average these numbers out, 132, I've got it at 134.16, which was pretty close to Morningstar. And then if we come out with CFRA, they've got their new calculation at 112.41, which is again a pretty big move up. And we divide that out. We've got a new fair value calculation on the stock at 126.19. And if we look at where the stock is after the pop, after the earnings pop, it's at 112.70. So we've got it now undervalued by about 12%, which is, I had it at 15 when I compiled the numbers. So it's a 3% change, guys. Again, if you're looking at Smucker and you're looking at investing in this company for 20, 30, 40 years, this 3% change relative to where I compiled the numbers, that really shouldn't scare you too much. And yes, it did pop after earnings, but not to the level to where it certainly looks fair or overvalued. I think it still looks undervalued. I think it's still a very compelling long-term investment idea. And I kind of break down the bottom line right here. GM Smucker has some of the world's most recognizable and popular food, coffee, and pet brands. They have an enviable share of market in a number of key categories, as we talked about earlier and as I showed you. They're positioned very well for business improvement and growth acceleration, especially on the international side, with the possibility that shares are 15% undervalued or 12% as of the publication of this video, or as the shooting of this video, on top of a near 3% yield, and it is still pretty close. This is a high-quality dividend growth stock that should be strongly considered for long-term investment right now. And Daily Trade Alert also adds in a nice little thing here where they have a dividend safety score, which is through Simply Safe Dividends. And they've got the dividend safety score at 91, which is obviously a very safe dividend. And as I talked about at the outset of the video, at the outside of the video analysis, I think GM Smucker will eventually have a 40, 50, 60, 70-year dividend growth streak. I see no reason why you can't expect growing dividends from a company like this for decades. For decades and decades and decades. I really don't. Nothing's going to change with peanut butter. Nothing's going to change with jelly. People are going to be drinking coffee at home for the next 10, 20, 30 years. Technology's not going to change that. People may buy this stuff online and have it shipped to their house. All the better for GM Smucker, frankly. Even easier to make your peanut butter and jelly and drink your coffee. So I see no reason why this company is going to change that much. And with it being undervalued right now, a yield near 3%, in this kind of market, especially with where food stocks have been over the last 3, 4, 5 years, guys. I've been investing since 2010. I've been doing this for almost 8 years, and this is clearly one of the best time. This is one of the best times in years to get into this stock. So it was a pleasure for me to put this video together. It was a pleasure to write the article. I hope you guys enjoyed the content. I hope you enjoyed the video. I hope it added value to the article I wrote. I'm truly humbled and honored to present these ideas. It's exciting for me to go over this stuff. I love it. It's something I live and breathe, and it's something that's provided me real life, tangible benefits and happiness. And as I spoke about earlier, it's Thanksgiving here in Chiang Mai, Thailand, but every day is a holiday for me. And I think if you put some of these mechanisms in your life, if you build that holistic lifestyle where it prioritizes saving and investing over spending and time over money and experiences over stuff, if you start to kind of change those priorities, I think you can make your day or make your life as every day is a holiday too. So hope you join me in financial independence. I hope you enjoyed the video, and it was a pleasure. Thank you so much. We'll see you next time. Bye-bye, guys.